Hi everyone, welcome to our second presentation on enhanced trust reporting. Today we're going to be covering some of the questions that came in our first session. But before we begin, I'm just going to go ahead and introduce myself and introduce my colleague Megan. So my name's Monica. I'm an associate with our tax group at Aird & Burles. I practice primarily in tax litigation and dispute resolution, but I do some advisory work on the compliance side. And I'll let Megan introduce herself.
And I'm Megan. I'm also an associate in our tax group. My practice focuses primarily on estate and trust planning and estate administration.
So today we're going to be, again, covering some of the questions that came through. I just want to give a reminder that this presentation isn't intended to be legal advice, but we do intend to provide some general comments on legal issues of concern to organizations and individuals. And if you do have some further questions that relate to particular scenarios, we'd be happy to answer them perhaps offline. So jumping into a recap of the new rules, just to orient ourselves before we get into the questions. So under the old rules, T3 was typically required if income tax was payable or if the trust had either a capital gain or disposed of capital property in the year. And now there are three main changes under the new rules, which means for you and for your clients that either some trusts will be reported for the first time, or trusts that we're already reporting will have enhanced reporting requirements in terms of beneficial ownership. So the first main change is that all trusts, unless certain conditions are met, will be required to file an annual T3 return. The second change is that trusts that are required to file a T3, other than what is being referred to as listed trusts, need to complete that Schedule 15 beneficial ownership information form with information about reportable entities, which include settlers, trustees, beneficiaries, or a controlling person of the trust. And finally, perhaps the most controversial new part of the new rules, bare trusts are now subject to the new reporting rules. So I mentioned listed trusts, and these are trusts that will be excluded from the Schedule 15 form, but not necessarily from filing a T3 return if they would have otherwise had an obligation under the old rules. So listed trusts, for example, include graduated rate estates and qualified disability trusts, as well as trusts having assets with less than $50,000. Now, that less than $50,000 threshold only applies if the assets are limited to cash or what we've seen as near cash assets, including public securities. And the exception will not apply if even nominal private corporation shares are held by a trust or gold coins, etc., are held by a trust.